Imagine your entire financial future, your retirement, your dream home, your kids' college funds, being decided by a single piece of bad advice. Sounds terrifying, right? Well, that's exactly what happens when you make financial decisions based on outdated habits and, even worse, emotionally charged, knee-jerk reactions. In the accelerated world of 2025, where artificial intelligence is no longer a futuristic concept, but a daily reality, continuing to manage your money the old-fashioned way is the fastest route to financial stagnation. You can't afford to be the last person on the block still using a spreadsheet when your neighbor's AI is optimizing their portfolio 24/7. Staying away from these obsolete practices isn't about being trendy. It's about avoiding guaranteed financial underperformance, wasted opportunities, and frankly, the soul-crushing anxiety that comes with not being in control. Welcome to AI in 2025 to advance your finance. This isn't just about what AI can do. It's about what you must stop doing to let AI actually help you. The first and arguably most harmful practice you need to ditch is emotional investing, driven by fear of missing out, or FOMO. We've all felt it, that sudden surge of panic when a friend brags about their latest crypto coin skyrocketing, or when a stock you were watching suddenly jumps 20%. You rush in, buy high, and then, almost inevitably, the bubble pops, leaving you holding the bag. This practice is harmful because it directly contradicts the fundamental principle of buy low, sell high. It turns investing into gambling, fueled by dopamine and social pressure. The impact on your wallet is immediate and severe. You systematically destroy capital by entering positions after the value has already peaked. When you follow FOMO, you're essentially paying a premium for someone else's success, and that success is usually fleeting by the time you hear about it. In 2025, the healthier alternative is algorithmic signal analysis. This is where AI truly shines. Instead of letting your brain's ancient wiring trick you into an irrational trade, an AI platform analyzes millions of data points, from market volume and historical volatility, to news sentiment and social media buzz, to identify genuine buying opportunities based on cold, hard probability. It removes the human element of panic. Your AI doesn't have a Twitter account, it just has data. By relying on signals and automated execution, you ensure your entry and exit points are based on mathematical advantage, not on fleeting emotion. This practice shifts your return profile from a volatile roller coaster to a steadily compounding curve. Next up is the incredibly common but financially destructive habit of manual, reactive budgeting using static spreadsheets. We've all been there. Once a month, you sit down with your banking statements, wrestling with columns and formulas, trying to figure out where your money went last month. The core harm here is twofold. It's reactive and it's backward-looking. A spreadsheet only tells you where you were, not where you're going. It's like driving a car only by looking in the rearview mirror. By the time you realize you overspent on dining out, the money is already gone. This passive approach often leads to budget fatigue, where the task becomes so tedious that you simply give up, opening the door to creeping overspending and anemic savings rates. The long-term impact on your wallet is hundreds, if not thousands of dollars lost annually to unnoticed subscription creep and inefficient allocation. The 20,000 som ababa senson bain, odur 25 bayan surdib. 45 solution is predictive cash flow optimization. Modern fintech apps fueled by machine learning don't just track your expenses, they learn your behavior. They can analyze your income patterns, recurring bills, and spending habits over the past 12 months to predict, with startling accuracy, what your bank balance will be 2 weeks from now. More importantly, they flag potential overdrafts before they happen and can automatically identify safe-to-save surplus cash. For example, if the AI notices you haven't used your gym membership in 3 months and your cash flow is tight, it can prompt you with an alert suggesting cancellation, a proactive saving mechanism no spreadsheet can replicate. This practice transforms budgeting from a punitive monthly review into a seamless, forward-looking automated process that actively helps you find money you didn't know you had. The third harmful relic is using generalized, benchmark-based retirement strategies. For too long, financial advisors relied on broad strokes, save 15% or invest 60% in stocks. While well-intentioned, these blanket strategies fail to account for the stunning complexity and uniqueness of modern life. Things like non-linear career paths, gig economy income, variable health costs, or the increasingly personalized nature of longevity risk. The harm? You're likely overpaying for risk you don't need, or, conversely, undersaving because the model doesn't recognize your specialized financial needs. The wallet impact is a retirement date that is either unnecessarily delayed or a portfolio that is needlessly exposed to volatility based on an average person who isn't you. This failure to personalize is simply unacceptable when technology allows for so much more. The healthier alternative is hyper-personalized goal modeling and scenario planning. AI financial platforms use sophisticated Monte Carlo simulations, running thousands of different market scenarios, inflation rates, and health cost variables specifically tailored to your current assets, debt, structure, and stated goals. They can determine with a high degree of confidence how a 3% shift in inflation or a 2-year career break will impact your 30-year retirement timeline. Even better, they can model what-if scenarios instantly. Want to know if you can afford to retire 1 year early by optimizing your debt payoff? The AI provides the data-backed answer, allowing you to move beyond generalized advice to precise, actionable financial engineering. This removes doubt and replaces it with data-backed certainty. The fourth mistake that bleeds your finances is ignoring personalized insurance and risk optimization. Most people buy insurance, home, auto, health, based on comparison shopping a few basic quotes. They treat it as a fixed cost or a necessary evil. The harm is that you're almost certainly either paying too much for unnecessary coverage or, much worse, have significant hidden gaps in coverage that could bankrupt you if a major event occurs. You're paying for the industry's average risk profile, not your own. The wallet impact is twofold: high premiums and catastrophic exposure. For example, if you work from home and drive less than 5,000 miles a year, paying the same premium as a daily commuter is simply throwing money away. The 20,000 budgets and data bodin Scots, Sombaya, Buddy 45 solution is behavioral and data-driven risk profiling. AI and IoT, Internet of Things, devices now allow for dynamic, personalized risk assessment. Car insurance companies use telematics to monitor your actual safe driving habits and adjust your premium quarterly. Health insurers are using data from wearables, with your permission of course, to offer discounts for maintaining a healthy lifestyle. Your AI financial aggregator can analyze your specific zip code, profession, and digital footprint, again, with consent, to identify the exact minimum viable coverage you need and flag high-risk areas, like an inadequate liability umbrella policy, before disaster strikes. This moves you from paying based on a generalized risk pool to paying based on your documented low-risk reality. This can slice hundreds off your annual premiums while simultaneously increasing your actual protection. The fifth dangerous habit is relying on human intuition for high-frequency trading or timing the market. While long-term buy-and-hold investing remains a solid strategy, the human brain is physiologically incapable of competing in the modern market landscape. High-frequency trading firms, powered by AI, are executing trades in microseconds. When you, a human, try to day trade or time the perfect dip, you are literally competing against algorithms that can process global news sentiment, trading volume, and technical indicators faster than you can blink. You are bringing a knife to a gunfight. The harm here is the potential for rapid, significant loss. Your wallet is impacted because your delayed reaction time and inherent biases, like holding on to a losing stock too long because you hate admitting a mistake, guarantee systematic underperformance against machine speed. The healthier alternative is automated execution and micro-arbitrage. Instead of trying to beat the AI, you let it work for you. Modern robo-advisors and advanced trading platforms use AI to find tiny, fleeting price discrepancies, known as micro-arbitrage, and execute trades instantly, securing small, low-risk profits that accumulate quickly. For the casual investor, this means setting clear, logic-based parameters, e.g., sell if this stock drops 5% below my purchase price, and allowing the AI to execute the trade immediately when the condition is met, removing the human tendency to hesitate and hope. You move from the losing game of timing the market to the winning game of optimizing execution. The final outdated practice that you absolutely must eliminate is fragmented financial life management. This means having your investments in one platform, your budgeting in a spreadsheet, your banking in a third app, and your credit monitoring somewhere else entirely. The harm is a lack of situational awareness and data synthesis. None of these systems talk to each other, so you can never see the full, integrated picture of your wealth. This fragmentation creates blind spots, A sudden spike in credit card debt might not be factored into your investment risk model, or your automated savings might inadvertently trigger an overdraft in your checking account. This complexity leads to poor decision-making and, ultimately, financial stress. The 22 Nastra Zuri Intin Berpomodobidon Sao. The 25 solution is unified AI financial aggregation. This is the future of money management, a single intelligent dashboard that securely links all your accounts, checking, savings, loans, 401k, brokerage, even crypto wallets. The AI then synthesizes this massive data set to provide a truly holistic view of your net worth, risk profile, and goal velocity in real time. It can instantly run simulations like, if I reallocate 10% from my low-performing mutual fund to pay down my highest interest student loan, what is the impact on my projected net worth in 5 years? This is the ultimate form of financial control, moving you from juggling separate apps to leveraging a single unified intelligence that is always optimizing your global financial position. This shift is about replacing blind spots with total clarity and replacing manual effort with automated synchronization. In 2025, the world of finance isn't just changing, it has fundamentally accelerated, continuing to rely on emotional investing, static budgeting, generalized retirement advice, broad stroke insurance, human market timing, and fragmented data management is no longer a sustainable strategy. It's a measurable handicap. The power of AI, in its form as algorithmic signal analysis, predictive cash flow optimization, hyper-personalized goal modeling, data-driven risk profiling, automated execution, and unified financial aggregation, is not here to take over your finances. It's here to give you superpowers. It's here to eliminate the noise, erase your biases, and provide the objective, data-backed certainty that humans alone simply cannot achieve. Your financial success is no longer about working harder, it's about working smarter by partnering with the most powerful analytical tool humanity has ever created. The time for hesitation is over. Don't let your financial trajectory be decided by obsolete habits. Take control today by choosing one obsolete practice to discard and one AI-driven alternative to embrace. Your automated, optimized financial future is waiting.